David, good morning. Great to see you. A lot to cover with you today. I'd love to start, though, with inflation and Steve's point about whether or not those sequential increases are behind us, whether productivity allows us to put massive inflation off the table. Where are you right now after this print?
Well, you want to think about it in the context of corporate margins, right? That's the transition between fundamental economics and what the equity market is focused on. And margins have continued to be very resilient for a couple of reasons. Number one is the skew towards technology, and net margins for tech companies are around 25%. That's twice the margins for the rest of the market. And the second is that a lot of companies are pushing through their higher input costs, passing through to higher prices. That's obviously what the inflation is measuring. And I would say the Goldman Sachs view is embracing the transitory view of the Fed as well. So I'd say the focus really is on this question of what are equity investors paying for? And Carl, they're paying for three things. They're paying for long-term growth, they're paying for margins, and they're paying for earning stability. So those three factors can explain the valuation, regardless of sector, why some industries, some stocks are trading high valuations, some are lower. The other attributes, market cap or sectors or the other leverage, things like that, those are not being ascribed more importance in valuation today than they have historically. It's long-term growth, margins, and earning stability.
Interesting. I'd love to get your take, David, on what is in the sell side's coffee this last couple of weeks as you see some macro strategists bring their numbers down. They say the path of least resistance is lower, but there's always that caveat that the drawdown risk is limited because of buybacks or what have you. What do you think happened after Labor Day? Because that's really when we got the bulk of those calls.
Well, I would say I would have a different view, and I would advocate that the path of least resistance is higher. There are always risks. There's a decelerating economy. There's the higher margins or higher inflationary pressures, some wage inflation, potential rate forecasts. All those exist. There's always risks. Sometimes they're different risks. And I would say why I had a more positive view, if you will, on the trajectory of the market is that companies have really responded pretty aggressively to these higher input costs. And that's what has led and will lead, and going forward, into pretty upward trajectory in profits. I think the biggest risk out there is taxes, and in terms of what's in the discussions with portfolio managers, it's been taxes. In terms of the proposals coming from the Ways and Means Committee last night and expectations, all the discussions last week about what the trajectory of taxes are. And so I would say the one risk that I would highlight and isolate is the idea that our forecasts for earnings are somewhat below expectations of consensus. And I think that's because we are assuming, my team, myself, we are assuming that taxes on the corporate level are going higher. And so that would lead the risk, Carl, to potential negative earnings revisions kind of as you look later into the fourth quarter, once the tax legislation, the tax hikes are coming into play. So I'd say that's one big issue. But I would say, so we look for where are our forecasts different from consensus. And Goldman, my colleague, Eric Sheridan, who initiated coverage yesterday on all of the internet stocks, significantly above consensus expectations on Amazon, on Google, and on Facebook. Obviously, three of the five largest stocks in the market. So that's one big issue, Carl. Another issue is those big five stocks now comprise around 38% of the Russell 1000 Growth Index. So that's 38%. That's extraordinary amount of concentration. And in fact, a lot of large cap growth mutual funds are deregistering as a diversified fund, because if you simply have the benchmark weighting, if you hug the benchmark, for example, you would be in passive violation of the SEC guidelines. So there's a challenge in terms of asset management of how to deal with this extraordinary concentration.